Hey guys, it's Paul here. Biontech and Pfizer got their approval in Great Britain, European authorities have it under a rolling review, and in the US they applied for an emergency approval. Moderna has come quite far as well. Especially stocks out of industries damaged by COVID benefited immense on these news. And since I've seen an amount of YouTubers making videos on Wynn Resorts in the last weeks, I thought why not make a stock comparison on Wynn and two other companies of the sector. So here it comes. A comparison between Wynn Resorts, MGM Resorts and Las Vegas Sands. All three companies can be assigned to the industry of hotels, restaurants and leisure, whereby Wynn is mostly specialized in the operation of destination and casino resorts. Lately, they seem to change their strategy a bit towards being more family friendly. MGM is a little broader allocated, operating some more non-gaming locations as well. LVS, the biggest player of these three, is not operating in the casino industry, but just hotels, resorts and also a high-speed ferry service. They are all operating mainly in Las Vegas and Macau, which is kind of the Vegas of the Chinese as far as I understood. LVS also operates a resort in Singapore that you already might have heard of, the Marina Bay Sands. A pretty impressive looking building concluding 3 towers and a boat sitting on top of them. I've actually been there back in 2015 with 2 good friends of mine. Well, we couldn't actually afford to stay there, we slept in a hostel, but we took the elevator up and looked around a little bit. But let's jump into the fundamentals to see how the businesses are currently valuated and if the valuation could be legitimate or not. Here's my little tool in action again. The company's pages always start with a small table showing industry, sector, market cap, ISIN and a link to the investor relations page of the respective company. The table is followed by a little description containing some rough information about the business model, products, where the money is earned, how many employees they have and so on. And if my database contains also a logo. Pause the video and read it if you are curious. So you can see here that they are all highly capitalized companies with both Wynn and MGM being a little smaller than LVS. Looking at the candlesticks charts, you can quickly see that unlike the semiconductors, hotel stocks are no 50 baggers. If you bought any of these in February 2010 and sold in the stock market low of March 2020, you would have earned almost nothing but the dividends they paid. I mean, this is something, but not what I would be looking for. Luckily for investors, the stocks already recovered since March. MGM is a 3-bagger, Wynn doubled and LVS is at least up 50%. But it has to be said at this place that LVS only fell by 50% before, whereby the other two lost around 70% of their value in March. So far, so good. Regarding a time frame of approximately 10 years, from December 31st, 2010 till today, Wynn is up 9.3%, MGM 107% and LVS 30.6%. Keep these numbers in mind. Looking at the revenues and margins of these three companies, you can already part-wise identify why the stock prices behaved like that. Wynn managed to increase revenue by 57%, starting at around $4.2 billion in 2010 and ending with a $6.6 billion in 2019. The margins in this time frame steadily grew until 2014, but stumbled back from then on, ending up at a net margin of 1.86% in 2019. Like so, the picture is pretty much the same in the following chart, showing the per share figures. EPS decreased and so did the dividends. At least the cash flows remained kind of steady. Still, these are not the kind of charts I want to see when I'm looking for a fundamental investing in a slow-growing industry. Regarding revenue growth, MGM did a little better with 114%. The margins underlie a massive volatility jumping up and down between -25 and +40%. In the last years, this improved a little. Since 2016, they are positive with a net margin varying around 14%. In the per share chart, you can see that this transfers to the earnings fluctuating a lot. The cash flows, on the other hand, increased steadily for more than 200%, which is why I conclude that they are a little more successful with their growth strategy than Wynn. Dividends are only paid since 2017. What leads us to the charts of Las Vegas Sands. They have the, in the long run, healthiest charts in my opinion, going from the bottom left to the top right. Revenues doubled since 2010 and the net margins stayed stable, varying between 14 and 19% with a slow upwards trend. The per share chart reflects this development pretty well. EPS grew with a massive 360% since 2010, or better 82% since 2011, which is more representative in my opinion. To recapitulate the numbers real quick. WYNN stock went nowhere in the last 10 years, and so did the earnings. Interesting how well the stock prices and the earnings correlate, isn't it? Right how it should be in the long run. Something you should keep in mind in these times, in which EV and hydrogen stocks grow to the moon. In the long run, a massive surge in stock price is only sustainable when revenue and earnings follow. Otherwise, they might fall back to Earth all the way from the moon. Anyways, the two other companies both managed to increase their earnings, what is also reflected in a rising stock price. What's also interesting is that despite LVS having 3 times the market capitalization of MGM, both companies end up with almost the same revenue. LVS's 2019 EBIT is not only around a third higher than MGM's, but also way steadier. The next chart I have plotted shows the quarterly earnings reports over time, and this data implies pretty much the same as I said before. LVS performs steady, MGM is volatile, and WYNN is not really growing. At least regarding the past numbers. What strikes my view right here is that LVS stopped paying a dividend as soon as it was clear that the coronavirus would last a bit longer. The others kept paying despite losing a lot of money. No need to say which version I prefer in such a case. I want the company to be able to compete in the long run. If the company has no profits, I don't want them to yield a dividend because it lacks foresightness in my opinion. The dilution charts are not too interesting in this comparison, as both new emissions and buybacks do not influence EPS too much right here. LVS is the only company sustainably buying back shares, but if you look at the relative change of shares outstanding, what they do has only little impact on the total amount. All 3 companies have quite an amount of debt, which is normal in this business. What's interesting is that WYNN's debt ratio is a bit higher than the others. The longer a crisis goes, the better is a lower debt ratio. And so is a cash reserve. Regarding cash and cash equivalents, LVS leads with around $4.5 billion, followed by the other companies that both possess around $2.3 billion. To set this in a context for you, last quarter, WYNN lost $760 million, MGM lost $572 million, and LVS lost $570 million. Remember, WYNN has the lowest market capitalization, so relatively they have the highest losses by far. That's it with the charts. If you like what I do here, I'd be really happy if you'd give this video a thumbs up, and if you don't, tell me what I can do different please. Let's get to the scoring systems. Regarding the Piotrowski F-score, which I made a video about, we have a clear winner. LVS scores 7 out of 9, and even the 2 figures that did not receive a point look like they are not too bad as well. The company only had a small decrease on their return on assets and their liquidity. Anyways, all in all 3 companies don't look too bad. Only WYNN's returns are a bit low. Also, the next score lets LVS look like a clear winner. This is because of the steadiness their cash flow statement already showed. Which you should consider looking at these scores is that first, the 10 years earnings growth of MGM is not a negative 200%, the number is simply messed up because of the negative values in their earlier years. Also, the expected return on investment does not make too much sense here. To date, I do not have integrated analyst forecasts yet. Due to that, I calculate the expected return out of the paid dividends and the trailing earnings. If they are volatile, the result simply put is crap. Regardless of that, I looked up some forecasts for you. Analysts estimate that both revenue and returns should normalize in a time frame of the next 3 years. Keep that in mind when you look at how far the stocks have already recovered. Moreover, both WYNN and MGM are expected to still have negative earnings in 2021. But at the end of the day, these are analysts' forecasts. And in my experience, you could also flip a coin, then your chance of doing the right thing is probably double as high as when you listen to their estimates. No hate actually, maybe a little hate, yes. The other score I have is pretty much the quality score, but set in context to all the other companies of their respective sector. It takes a look at the individual figure, and if it scores better than 66% of their competitors, it receives a point. Again, this score still has its little code problems, so some numbers like the PE for example are not valued correctly at the moment, especially when they are negative. Besides that, it can already give you a great overview on how the companies are doing compared to their competitors. You can see for example that growth at LVS slowed down, whereas it accelerated at WYNN, whereby you should consider that they come from different starting points. LVS seems to be way more profitable compared to their assets and equity. Also, their debt to EBIT ratio is great. Just one normal year and they paid off all their long-term liabilities of their EBIT. For a company that's operating resorts, their net margin is pretty high. The only thing striking my eye here is that LVS's valuation regarding their revenue is the highest right here, the KUV. The rest is looking pretty damn good for a company that's usually paying a high dividend. At this point, I'd like to tell you again that I'm no financial advisor. I just want to help you at making your decision by feeding you with the data I process in my tool. In addition to this video, I'd recommend you taking a look at the company's investor relations pages, and I'd also highly recommend you to check on news and outlooks published regarding these companies. They may have expansion plans, for example, that are not visible in the data right here, or that even affected those negatively. One last thing that could be important: wealth in the Asian area is rising, and so might the demand for luxury resorts there. I really like to see that all three companies are investing there. Furthermore, I think that Singapore is becoming more and more important as a strategic point connecting Asia to the European Union and the African continent, and I think that LVS did a good job recognizing that early. But that's it now. The video is getting too long, and there's probably only one person watching till this point. So thank you for tuning in, and hopefully see you in another video. Stay rational.